Markets, the channel for learning about trading and investing. Welcome to another episode of the markets. Next week, the weekly stock market analysis show where we look at technical charts and try to understand what happened in the market during the week, and also try to plan for a better trade for the upcoming week that's starting from tomorrow, November 25th, 2024. So let's get started. Here we go. This is a bird's eye view. The weekly charts of the Nifty on the left side, right side you have the daily. We see a trend line, kind of a channel, and market had gone for a correction of nearly 8 weeks. On the daily on the Nifty, you can see that the market had broken down from that head and shoulder, and then Friday had a big reversal. Here you have a narrow ascending wedge, and it almost broke the narrow ascending wedge, and then previous week had a kind of reversal. And right side, by the way, this is the Banknifty charts. Okay, right side has the Banknifty daily charts, where you saw a breakdown of that head and shoulder, but a quick reversal in a Friday, big solid bullish candle from the bottom of that parallel channel. So what exactly happened is Nifty corrected slightly further, some more, and then reversed. So finally, it is a positive week of 1.62. That's 382 points up, but still it's below the 20, 50, 100 all this expression average. Remember, so we now already have 11.5% of our corrections in 8 weeks. That's in the 70% bull rally from June 2022. So bank index was even more volatile. The Nifty was volatile with V-shaped reversal on Friday, but Banknifty was even more volatile, and they also ended up in some more correction, but did not go much further and reverse immediately, and finally closed nearly 2%, 966 points up, and still below the 20, 50 and the 100 exponential moving average. So correction is 6.6. So Banknifty corrected less than Nifty overall, you see. So candle sequence, if you see, it's a bear trap bullish, right? Otherwise weekly candle, it's a bear trap weekly candles that you see on both indices. It's almost like an inside bar. If you consider only the body, it's so it indicates some consolidation, and a reversal or bottom might have been found to trap the bears. And daily candles is a solid bullish wide range candle, right? But the lower high pattern continues to be there. It can be breached only above 52.5 on the Banknifty and only about 24.500 on the Nifty. So that's the story written here. How about the Bollinger Bands? So you have an expansion that was happening. Now it's a small contraction has begun on the Nifty with the Friday's move, but it's bearish bias because it's below the median of the Bollinger Bands. Banknifty also expansion on the downside on the Bollinger Bands on the daily has turned into a small contraction beginning, but bearish bias, of course. So bearish bias consolidation may be happening if this holds on. That's what Bollinger Bands are talking about. Moving ahead, if you try to see the momentum in the trend indicators, the RSI and the ADX that we are seeing, left side here the Nifty weekly and Banknifty weekly, on the right side here the daily chart. So weekly term momentum has picked up, and you can clearly see that it is in sideways in the rising mode, while even the short term also momentum also has picked up on Nifty and the Banknifty both, and then in fact it has climbed to sideways. So that's a very positive gain of the momentum that has happened. But so this is a summary of that, making out of that. The ADX indicates that the bearishness is still there, right? The bearishness is falling, reducing in the case of short-term trend indications on the Nifty and the Banknifty. So short-term bearishness is still there, medium-term bearishness is still there, but it's reducing. Overall, Nifty and the Banknifty both remains. There is a correction here, sorry about that. So this is turned to sideways. You can see if you consider, right? So this is a mistake. Yeah, so that's about it. It's a sideways momentum, and bearish falling. But look at this. It's a VD of weeks, which is spiking up to 9% a week when Nifty had a big reversal. So that's some kind of worrying. There is some kind of tension or fear in the market, and now it's at 16. 16 is above the median volatility range, so you have to be very careful about the India weeks behaving this way, right? It spiked up 9% when it's supposed to have cooled off. It didn't happen. Upper address for the November 28th monthly expiry and November 27th Banknifty's monthly expiry. So it's all green out there. It's bullishness of where I PCR is of 1.1 and 1.2 in the Nifty and the Bank respectively, and we have a short covering and the long build up that is seen on the futures on Friday. So overall bullishness in the open interest, no doubt about that. Now open interest also we can find the levels of probable supports and resistances as per the OI is listed here. Here it starts with the charts above that. Study both of these levels and then try to conclude on a support resistance level. So OI is showing that 23,500 and 24,500 is where the highest put and call writing is there for the next week, monthly expiry. 51,000 and 52,000 for the highest put and call writing on the Banknifty is there, right? PCR in the OI build up on Friday is absolutely bullish, no doubt about that. So making all of these levels, that's based on these charts, that technical charts, that's another way of finding. So basically we are using moving average of 20, 50, 100 and 200, and then previous resistances, previous swing lows, and the Fibonacci combination. This is what is used. So if you quickly see, you can see that the major resistance is coming at this one of 24,500. Before that you have the 24,000 rounding number. It's also going to give a big resistance. So 24,000 has been a previous resistance and 20 exponential moving average, and so that's going to be big resistance. If that is taken out, then 24,500 would be the major zone of resistance, and after that you have small previous resistance. So basically this lower high lower hope pattern would get reached above the 24,500. A clean close above that would mean that probably the bottoms are found there. Until then we never can say downside. Those Fibonacci 61 levels at 23,200 is where the major support is going to be. After that 23,000, then 22,800 and 22,500 likewise the supports at the downside. After on the other hand is at a major resistance zone, it could not close above the 50, 100, 20 exponential moving averages. So that's going to be a big hurdle that's going to come in at 51,500 nearby zone. So once that 51,500 is cleared and green close above that would mean that next major resistance would be at 52,000 rounding number, and 52,800 where gap resistance is there. Then 53,000. So that's how the resistances are there on the upside. Downside, Banknifty would have the 200 exponential moving average at 49,825, which is going to be major support, and previous swing lows are there very close by that at 49,650, and then 49,000 rounding number. Likewise, that's the supports on the Banknifty. All these are mentioned here. Here the DMA is the exponential moving average, PR is previous resistance, RL is rounding number, and Fibonacci, Fib is Fibonacci, right? PSL, previous swing low, right? So correlate these two kind of different methods of finding support resistance and come to conclusion. Let's move ahead. If you look at the major sectoral indices, you can see that all of them have bounced up. Reality doing is cool 6.3% up, FMCG 2.2%, found by 1%, 2.8% on auto. Metal is only one that has not bounced up much, it's flattish close, while IT has bounced up 2.2%. So overall all of them have bounced up and made big gains except the metal. IT is only sector where we can take the long positions because it's bullish momentum on both time frames, lower and higher. Now that's all. You just have to wait for the bullishness to appear on both time frames before I can take long positions. Now the bullishness is still there in the short term in the case of FMCG, right, and also the metal. So these are the two sectors which are still having some struggle to climb back to the sideways, otherwise we're fine. All this can be seen in this chart that's mentioned here. Right on the top is the Nifty IT index, it's in the bull zones, medium term, and taking a support and bouncing up is what you see on the metal bond support of momentum at downside 40. And also auto is also taking a support at downside momentum 40 and then bouncing up. Here Pharma has slipped in the sideways and then trying to reverse. FMCG is also fallen to the bear zones and then climbed back to the sideways momentum outside above 40. And down here the reality, which is again taking a support near the outside 40 and then bouncing up. So that's our overall picture of the different major sectoral indices. If we look at the heavy fields, HDFC Bank has once again bounced back. That's the 8th or 9th time of just trying to break out of the 1,800 zones. If that happens, it will be a big mega move. Also, the trend has not taken place, but HDFC is just managed to climb over the bull zones. Reliance still not recovered. Small bounce from the big sides can be seen, but there's some more space to go below the 200 or 100. 100 it can go because there is more space towards the bottom of the trend line, so it could go there. So Reliance is the only major heavyweight stock that has not recovered so far. which is in bear stance in the momentum, and it bear stance with respect to the trend indicator readings as well. ICICI Bank managed to climb back in the bull zone. So ICICI Bank and ICICI Bank is what is holding the market, and along with the ITs, which is it was just climbed back in the medium term momentum or bullishness. Well, Nifty is trying to do that, but not right now. As usual, Kodak Bank will be sideways, and ITC is also trying to reverse and then climb back and reclaim that momentum outside, but still sideways as well. So it's HDFC Bank and the ICICI Bank that's calling the market. Reliance is continuing having troubles, and others are IT is helping, IT stocks are helping, and Kodak as usual sideways. Total market also seems to have bounced last week. Don't know whether it was at the end of that bottom channel. It has done decent corrections, and if it is holding, well and good, but it corrected along with the major index. Right, that's the broader market indexes that you see, which seems to bounce up. If it sustains, well and good, but sideways moving massive now. And moving on, the institutional participation is 16,000 crores selling once again. DS about 11,000 crores of buying, which is not enough. That's why market is at trouble. Now that rate is also DS somewhat flattish. So DS have been continuously selling since the last 2 months, and it's more than 1.5 lakh crores of selling money has, billions of dollars moving out, and domestic institutional money from the mutual funds is flowing. Then that's what is holding the market. Let's have a look at the global markets, the currencies, commodities, and all that. Dollar is spiking up, 0.76 up this week, and it's an 8% from the single up. Momentum is bullish and rising. Not that great news for emerging market like ours. USD now is also weak, continued to be weak. It was a flattish close, 84.4, which is also not that great for India or our economy or our markets either. Crude oil is spiked up suddenly. A big spike has happened, not sure why. 6% spike, and it is at 71.2. That's a mistake there. It's at 71.2, and that's what I see. Gold has also made a big spike. Gold, look at gold, right? Gold has also had corrected decently, and then quickly bounced from the 23% Fibonacci extension, then once again heading towards the all-time high. Gold is spiking, then we may have trouble. So two not so great news for the last week is that gold is suddenly back spiking up, and then VIX is also spiking up. Otherwise things looks to be giving a clue that probably we have found a bottom. Never know. But that's the news there. Crude oil is up, gold is up, and US market is green. US markets, if you look at the Drawdowns, S&P 500 and the Nasdaq indices that is shown here, you can see a big bounce up after a small red candle of perfect booking probably. Momentum is bullish and rising up. S&P 500 is 2% down. Dow Jones is 2% down, near 2% of S&P 500. So Nasdaq also. So overall bullish momentum and rising up. So US market is the market and it's rising up is good, but dollar rising up is not that great. And crude is under control, although it's spiked up this week. The gold spiking up is again a worry. Now let's move ahead and see what are the two actionables for next week. One is lower slabs, it's a farmer stock. Climb back in the momentum, it's a panel channel. If that breakout happens, you can easily get a 1:3 risk reward trade. Momentum trend is bullish. It's in a trending line. There's a probability that it can break out. Right, so it's a reasonable trade. Federal Bank also is a consolidation. The breakout is almost attempted, and if it continues, you'll get a risk reward of 1:2. Momentum is bullish, trend is bullish. Price pattern seems to be a consolidation breakout. Two stock picks for the next week: Bank stock, Federal Bank, and farmer stock, lower slabs. Now here we have the FNO strategy on the Nifty for the monthly expiry next week. Basically, this is a bear call spread. So if this market is correcting or continuing extending the correction, means the nobody's will be saved. But if the market is breaking out and reversing ferociously, then we have a trouble. Just exit in that case. Basically, we are selling an OTM. Basically, we are selling a near OTM, right? Plus 124,000 call, and then covering that, hedging that with the further for OTM call 24,300 to cover that. So the reward is not that great, but that's the only thing that you can do when there is uncertainty as to what may happen. But the falling down will be very hard, so we have to cover that. So that's what bear gold does. So we completely hedged risk reward. Exit in case it bridges. Don't try to adjust, especially for the monthly experiment. It will be very volatile. So that's definitely a weekly strategy on the Nifty for the next week. Let's wrap it up. So market trapped the bears this week with a quick reversal after extending the correction to nearly 11% on both indices now, and finally both of them close clean, and the correction is extended. So 11.4% overall, but the rally has gone to 70% nearby. So the bad part is that the FIs continue to pull out the money. That's the bad thing. So let's now try to bucket together the different aspects in favor of the bears and the bulls, and then try to reach a conclusion. So for the bulls, US indices of green is very positive. The money is continuing flowing even after the FIs are selling heavily. Is a very positive factor. And all futures are bullish, all PCR is bullish, daily candlesticks are bullish. Bear trap is bullish, bunch bands are sideways, and recurring contracting is bullish. Major heavyweight stocks have all climbed back with sideways momentum is bullish, except the Reliance. Sector indices are reclaiming the medium term sideways momentum. Total market is also seems to be bouncing up and then found the bottom there. All these are positive factors for the bulls, but for the bears, the lower high pattern is still giving a threat. FIs continue to heavy sell is a threat. 20, 50, 100 still could not be covered by both indices in spite of the reversal is a worry. India VIX is spiking up 16 is a worry even when the market bounced up on Friday. That's something of course of concern. So gotta be cautious. There are a lot of things in the background, the US election, new presidential tariffs and all this Middle East crisis and all these things still there. So that fear factor or something is not very right, so to be very cautious. Technically charts, my view for the next week is mildly bearish. It was mildly bearish, but it's mildly bearish now. So keep that in mind, the technical levels and charts and all that can screw up if there is a black swan events due to some big major events like the war, pandemic, election, recession and all these things. So you got to be fully aware of that. You can only speak about probabilities, not confirmations with the technical charts or even the fundamental charts. The levels for me the next week is 23,000 and 24,800 in the Nifty and 49,500 and 52,800 on the Banknifty. Right. So as long as it's 26,000 and 54,000 on the Banknifty is not conquered, you still may be consolidating until then. So all that you can do is protect your capital. How do you do that? It's the hedging the positions that you take in derivatives and hedging portfolio level, and hedging can also be used to get link and option strategies. Check out the playlist for that. So that's all I have. Market views might be bearish. There's a possibility that the market may have found a bottom at that reverse and then goes back to 26. It may happen, but we never know. As of now, there's no confirmation yet. But a good first attempt was made last week. Let's see some substance and summary of what the analysis is all about. So if you like the content, subscribe, like, put in your feedback, and share to others. I'm also present in Twitter or X, for daily updates and all that most of the time. Thanks for watching. Happy trading, happy learning, happy investing. Bye bye.